Hello, chart watchers and DecisionPoint faithful. Welcome to this February 14th, Valentine's Day edition of DecisionPoint. My name is Erin Swenlin, and I'm here with my father, Carl Swenlin, and we are going to show you the charts that are making us say, So let me go ahead and first introduce my father. How are you doing today, Dad?
Very good. Happy Valentine's Day.
Yes, to you as well. All right, so let's go ahead and take a look at our agenda. Carl's going to start us off with a talk about bubbles, and notice it is plural, so there's lots to discuss there. We'll look at our regular market overview and indicators as usual. I want to show you the new highs and new lows chart and how it gave us a very good indication when the bear market low came in. So I want to show you some of those charts. I'm going to look a little bit more closely at gold miners and finish with the diamond of the week. So let's go ahead. And before I start, I wanted to mention that on Mondays, I had my trading room this morning at noon Eastern, 9 a.m. Pacific time. Every Monday, I have a free trading room that you're welcome to attend. If you go to our website on the homepage, you'll see my picture and an ad for that trading room. Just click on it and you'll be able to register right away. You only have to register once. It's a recurring room. So I hope you will come and join us in all of the fun we had this morning. All right, the DecisionPoint sector scoreboard. Where do we stand right now? Well, as far as the long term goes, we still have a lot of these sectors with a 50-day EMA above the 200. So they are still on long-term trend model buys. Communication services lost that 50-200-day positive crossover quite a while back. It is the only one on a long-term trend model sell. Now, we've had a lot of shuffling going on in the intermediate term of sectors, sector scoreboard here. We've had a lot of buys and neutrals appear, obviously quite a few neutrals. The only ones that really have escaped the neutral signals are consumer staples, energy, and financials. A look at the sector chart for energy, and it's pretty obvious why it is still on a buy. 100% of all of the members in energy have price above their 20, 50, and 200-day EMAs. Every single one of them has an intermediate term trend model buy signal on it. And the last I looked, all of them had a long-term trend model buy as well. So energy is still showing a lot of strength. And then financials are on a buy. We'll have to see how the rising rate environment affects a lot of these financials. And of course, consumer staples being in that defensive area, we do still have a buy on that one. All right, let's go ahead and look at some charts. But before we do, Dad, I'm going to let you take it over and talk a little bit about bubbles.
Right. I was going to start with bubbles, but I just realized I have a chart that I want a table that I want everybody to see. And that is here.
Yes.
We run this one every Friday, and over the weekend I added another column to it. And so we have the Silver Cross Index, the Golden Cross Index. We subtract the golden from the silver, and we end up with an IT bias. I'm calling it for now, but that shows us how much further down the Silver Cross is compared to the Golden Cross. And of course, right here we have energy at 100%.
Yes.
Beautiful. And notice that gold miners has actually got a plus in the IT bias because Silver Cross has overtaken the Golden Cross number. So that's showing some strength there. Also notice, all right now, 72% for S&P 500 in Golden Cross, but much weaker in the intermediate term. That you would have to say this is a bear market. It's below 50%, and much weaker in the mid and small cap. Notice the Nasdaq Composite only 21% on a Silver Cross and only 32% on a Golden Cross. You're going to find, expect that to be the weakest index because their there's so many cats and dogs in that index. New York Stock Exchange Composite also weak in the intermediate term and weaker than bigger indexes in the long term. Notice the NDX, 23% Silver Cross, I'm sorry, on Dark Cross, 23% on the Silver Cross, which is way down. On the almost half or have a Golden Cross, and so that's not looking very healthy. OEX, that's the most 100 largest stocks in the S&P 500, and of course they are matching the bigger index there. I have the grouped. I have the broader indexes at the top. We keep track of these stocks. The stocks in these indexes, but these are more like sectors. But I don't include them down here because this is the 11 sectors for the S&P 500, so I keep them separate. But notice the gold miners again, 33%. And I think, do you have any questions on that?
I would have to say just what your take is on communication services. It's the only one right now on a long-term trend model sell signal, but we're starting to see a little improvement there under the surface.
Well, at face value, and I have to say that it's showing improvement, but I really have to look at the chart, which I can do.
Well, why not, since we're talking about it, huh?
Right. The Golden Cross indexes, and that was communications. Okay, yes, you're seeing definite improvement in the intermediate term. Silver crosses are increasing, and they were down about 10%. So there is definitely life being shown in that index. Unfortunately, it's not showing up in price in the
yes.
But you have to remember this is a cap-weighted index. Okay, moving along.
Bubbles.
Bubble, toil and trouble.
Yes.
I don't have any graphics for this, but I read an article by Jeremy Grantham, who's well thought of in the business, about 2 weeks ago, and he's talking about there are 3.5 bubbles going on out there. We have, I've been watching housing and equities, but he also says we have a bubble in bonds, and let's see about that. Yeah, okay, this is the inverse of the bond index. This is interest rates, and that this is at I don't know how, maybe it's the all-time low of all time.
Mm-hmm.
It's just, so the inverse of that would be the bond index would be at all-time highs or near it. So yeah, there's in bonds, and he also says there's a half a bubble in commodities. I didn't get into that because I don't follow commodities that closely, and but I'll just take his word for it. And the thing is, in 2000 we had a bubble in equities, and that didn't work out well. In 2007 we had a bubble in housing, and that didn't work out very well. And the thing is, we've got all three of these together, with housing, equities, and bonds, and this is not going to end well. I mean, I don't know what's going to happen. I don't think there's anything the Fed can do that's going to mitigate it, except steal more money from other people. Yeah, so I just, on top of all this, we've got the cryptocurrencies, which are tulip mania without the tulip bulbs. We have these things called NFTs, non-fungible tokens, another crazy thing that people are spending their money on. Then, of course, we have unfunded pensions out there, and those haven't reared their ugly head yet, but they will eventually. And then we were concerned about foreclosures. Nobody's talking about that because of people were able to delay their payments on their mortgages through the COVID thing. And I don't know when that's going to pop. But going back to housing, one of the things we watch is the House and Garden TV shows about house hunting, and one of the things that is I see across the country is the buyers are having to go in with an offer above the ask so they can have a chance to get the house. I mean, it doesn't look like a frenzy in a frenzy sense, but it is a buying frenzy when you have people bidding more than the ask. It's crazy. Right. So that's it. It's
if you show the 30-year mortgage rate chart, that's pretty telling.
30-year mortgage.
Yes.
Yeah, let me find that.
You wrote an amazing article on this particular chart, so I thought it would be good to highlight that mortgage rate chart, because I know I brought it into the free trading room this morning, and I know it might have shocked a few people, honestly, that it has
really,
risen that quickly. One more there.
Okay, here we go. And this is again an all-time low, I'm sure, down here. Back in 2021, right at the beginning of the 2021, and you can see that it's trending upward now, and it's going at big jumps. The one other thing I wanted to talk about is the interest rates. Let me go to the interest rate array. Okay, here. Hasn't updated today yet, but if you notice on here, there's if you look at the rise from about here to the current, let's say of this this is the 1 year.
Mm-hmm.
That's not right.
Something. Oh, it's on the 30 years. I'm not sure.
No, this is about a 20% increase from this low to where it recently has been. And you wonder, how can I participate in that kind of a move? 20%. You can't get it in the bonds, but there may be some instruments out there that people are using that I'm not aware of. But recently I did find, heard about this ETF, this Simplify Interest Rate Hedge, and ETF, and it's basically the people that run it, they are buying interest rate options. So if you notice here, from the low on this chart to here is at over 20%, which is a nice move to be able to participate in that kind of move. Okay.
I think they have an ETF for everything now.
Yeah, and I put that on our list. Okay, I better get to work. Today, the markets started out up and went down, and it's still closed down, but it's not that bad. I'm not sure what to make of this. This candle is not a hammer, so that's not nailing down a bottom, I don't think.
I agree.
But here, they're confirming.
For sure.
Yeah. Yeah, that's another. I keep looking at New York, and I know it's not updated. Okay, we have an expansion of new lows today, not horrific by any means, and you're going to be covered that later.
Yes, I am.
Just to get an idea, we talked about the stock bubble. This is the like advance, and it's broken down, and I think it's going to stay down. The PMO, monthly PMO, is topped, and that is a bad sign for long term. Climax assessment. We got a marginal day today, but you see, we're just about making the limits of each one that we're looking at. We're still waiting for the New York, but see, it's just barely there. Almost. I'm definitely calling it a downside exhaustion climax. Excuse me, I'm this thing that gets in the way. Okay. Short-term indicators.
Negative now.
Yes, yeah, negative, and plenty of room to get more oversold. And here's the intermediate term indicators. They've turned back down. Bitcoin, looking at that today, I had to really get in there and look at this head and shoulders pattern. This is the neckline. So what we've done, broken down from the neckline, 52% decline from the top, and now we've rallied back towards that neckline. We're running into trouble at this line of resistance right here. But I have to say, from here to here is a 20%. I'm sorry, it's like almost a 40% advance. So it's back in a bull market, which I don't know. It's cyclical. And I don't know how long it was likely to last. The dollar rallying again, but one of the nice things about that is that it didn't stop gold today. Gold had another really good day, and we've only, from here to here, we've only had 2 down days. So we still got to get across up above this resistance. And I'd say I feel pretty good about it at this point.
Yeah, it does look very favorable.
Oil still rallying, as we would expect. Let me just check it to see what WTIC is looking like. Yeah, it rallied today up 2.53%. Treasuries struggling, as they will continue to, I expect.
Yeah.
And I think I better turn it over to you so you have some time.
Oh, yes. Okay. Let us get the screen ready here. Of course, I've been watching your charts, so I didn't get mine all the way ready. All right. So the chart I'm going to bring up is, we're talking about bubbles. We're talking about market, bear market. I was asked in the trading room today, well, what is it that might tell us whether we're at a market bottom or not? So there were 2 things that I showed. The first one being our indicators, actually, Dad. I showed this with our short-term indicators and our longer-term, intermediate-term indicators. And I said that, what we're going to watch is for confirmations out of these short-term with confirmation from the intermediate term. We'll want to watch for, like we have right here, those positive divergences. And you had one down here as well. So those are the kinds of things we're going to be looking for a solid market bottom. But one of the things that I remembered, and we had talked about, Dad, you and I, was there was one indicator. I was like, there's one indicator. I remember it was right on. It really picked the bottom of the bear market. And you responded that I'm pretty sure it's the new high, new lows chart. So let me go back in history and then we'll look at what's going on right now. So the nice thing is with stock charts, I can change my range to select that start and end date. And so now I have this little slider. So I'm going to slide it all the way back here so that we can really get a look at what was going on back in the end of the bear market. But notice you had these declining price bottoms, and then all of a sudden we started to see new lows contracting. And that was really the signal. We really hadn't seen anything like that in this bear market. And that was a pretty good signal. And there were other confirmations that we had at the time, but this one was a pretty bright one. Now, if you go to the New York Stock Exchange, you'll see a similar thing in history. And similar, I don't have the vertical right here, so let's just put it in like this so we can see. So notice, again, we had those new lows expanding, and then they started to contract. And that led right on into the end of that bear market. Now, I'm not saying this is, it'll happen for sure, but I know that you and I were getting a little bit excited when we looked short term at this new high, new lows. Notice that we had these declining bottoms, and then we were starting to see lower new lows. And that was a pretty good signal. We're thinking, all right, well, maybe we're going to see a little bit more, and this is near the end, because it was coming right up here on support as well. And so we were like, that looks pretty good. And then we pulled up the new high, new lows for the NYSE. Same bottoms, but new lows, not contracting, not at all. So that's what we're going to be wanting to watch for when we're in the midst of one of these declines. We want to start seeing those new lows start to contract while price is still going down, because that's what will give you that positive divergence. Right now, yes, they're contracting, but that's really just confirming that move that we had here. So we're looking for divergences, not confirmations. So that was, I thought, a pretty interesting look.
For future reference, the NYSE should always check that one along with the S&P 500 new highs, new lows, because it's more consistent. It's more consistent in giving you these divergences. The S&P 500 is the stocks are all large cap stocks,
right? So more homogeneous.
You don't have the diversity in that index.
So those are the things that we will be looking for. I mean, there's going to be a lot. And of course, our DP Alert subscribers feel confident in that we will alert you to any of these situations when they arise. We did talk to our subscribers, talk to them about these new lows contracting, but then tempered expectations by looking at the fact we didn't have that same positive divergence on the NYSE. All right, I want to look at gold miners. With gold doing well, gold miners should benefit. And right now they are beginning to benefit. The best part about this chart, we have this for gold miners. We don't have it for every industry group, but this is one we follow closely alongside gold. And so we have those under the hood indicators that measure participation to really tell us what's going on under the surface. Is this for real or is it not? And I really have to say this breakout looks great here from that symmetrical triangle. These are continuation patterns. So it would be continuing this uptrend that we had before it went into that symmetrical triangle. So we do expect prices to move higher. We've got a positive RSI. We've got a PMO buy signal. It just managed to get above the 0 line. But this is really where we're looking. You can see that silver cross index, we're at 40%. So 40% of those in this particular group have a 20-day EMA above their 50. So 40% are on silver crosses, almost 40% on the bullish percent index. And then we have the golden cross down here. It's only at about 17% of those stocks, which tells you just right off the bat to temper your expectations somewhat, because a low reading like this on the golden cross index tells you a lot of these stocks in this group could be and probably are in bear market moves. So we just want to keep that in mind as I show you how bullish this looks. So you can see that 100% now of the gold miners have price above their 20-day EMA, over 3/4 above the 50-day EMA. those numbers well above the silver cross reading. So this tells me that with this kind of participation under the surface here, as far as stocks above their 20 and 50, that is higher than that silver cross index. So that tells me that there's a bullish bias going on. Add to that, like I said, we talked PMO, RSI, BPI is rising, and then also stochastics have just gotten above 80. So I really like the look here. We did get the breakout above the 200-day EMA. I'm going to temper my expectations because the 50-day EMA is below the 200, and we are hitting this overhead resistance here. You can see where that matches up on the gap to these price highs. So this might be a little difficult for a push to the upside, but boy, when you see that gold chart looking as strong as it does, I don't know. I think gold miners look pretty good right now on this breakout from that short-term trend. Which brings me to the diamond of the week. And I decided to do a gold miner. I ran one of my scans that looks for PMO crossover buy signals. And this one came up and I thought, well, this is perfect. It's a gold miner and I'm talking about gold miners looking good. So what are we looking at here? Well, this obviously is a much bigger move than we saw from GDX itself, the gold miners. But so that does suggest that there is some internal strength here for sure. We do have that 520-day EMA positive crossover. Let me take this out. You can see the increase in volume look at the volume here, numbers, as we're breaking out above that 50. So I'd like to see a follow through day, honestly, because this was where we saw some breakdowns. But I suspect that you will get that follow through. And you can see that as far as the group goes, when you compare AEM to its industry group of the gold miners, you can see that we're getting some outperformance of the group itself. So we have a lot of strong stocks right now in the gold miners. This is going to be helping me to determine which ones have the most strength within that group. And AEM pretty much fits the bill. But I mean, I was looking at some others in the trading room. Rand Gold looked pretty good. It's actually broken out above this prior high. So I think that one looks pretty good. And look at the outperformance of Rand Gold in comparison to the industry group itself. So honestly, I would say gold, GOLD here, Rand Gold, or Barrick Gold, my mistake. And AEM, Agnico, isn't that what it was? Yes, Agnico Eagle Mines. So those two look pretty good in the gold miners, but if you have your favorites, I would go and start taking a close look at those charts. That's all we have for you today on the DecisionPoint show. I wish you happy trading and good luck as we move forward.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.